Hi, I'm Ashikur Rahman. Welcome back to my channel Accounting Celebrity. Today in this lesson, I will show you 15 important formulas in analysis and interpretation chapter. So this chapter is often called ratio analysis. This video will have 3 parts. In the first part, I'll show you 5 formulas today. So let's get started. Okay, number 1 is gross profit. Gross profit as a percentage of sales. Okay, so what is the formula here? Your formula is gross profit divided by sales revenue. Yeah, sales revenue times 100. Okay, so in your exam paper, if you have gross profit, if you have sales revenue, it is pretty easy to calculate. Okay, for example, your gross profit is here $1,000. Your sales revenue is $10,000. Okay, multiply by 100. Your percentage is 10. Okay, so it's very easy. But when you have no sales revenue or no gross profit, in this case you need to calculate your gross profit first of all. Okay, so how to calculate gross profit? You know, sales revenue minus cost of sales equal to gross profit. Yeah, so what about cost of sales? How to calculate your cost of sales? So you know, cost of sales equal to cost of sales equal to opening inventory plus purchase. Okay, then you have to add carriage inwards, then you need to subtract minus purchase return minus closing inventory. Okay, this is how you can calculate your cost of sales. Okay, when you will have cost of sales, you will have sales revenue, you can calculate your gross profit. Okay, so it's very easy. Yeah, let us to next one, number 2. So here net profit as a percentage of sales. Okay, so here net profit is also called profit for the year. Yeah, you already know it is profit for the year. Okay, so what is the formula? It is here net profit or profit for the year profit for the year divided by what? If you say sales revenue, you are correct. Times here 100, okay? For example, your profit for the year is $500, okay? Your sales revenue is $10,000 multiplied by 100. So your answer is here 5%, yeah? Very easy to calculate when you have this information. But if the value of profit is not given, you don't know what is your profit for the year. In this case, how to calculate profit for the year? You know, profit for the year equal to profit for the year equal to what? Gross profit plus incomes, yeah? Incomes minus, guess what? Yes, expenses. So minus expenses. Okay, so here your gross profit already you have, okay? So with the gross profit you need to add the incomes. So what are the incomes? Like interest received, discount received, commission received, rent received, okay? These are basically your incomes, okay? So you add these incomes with your gross profit. Then you subtract your expenses of the business. What are the expenses in the business? Like stationery, office expenses, wages, salaries, then motor expenses, okay? This will be basically your day-to-day basis expenses. So you have to subtract them after you add incomes with gross profit, okay? So this is the way you can calculate your profit for the year, okay? So it's easy, yeah? So here you can calculate your sales revenue. How you calculate if you have no sales revenue in the question? So you have your gross profit, yeah? Sales equal to gross profit plus cost of sales. Cost of sales also called cost of goods sold, okay? So if you add these two values, you can also calculate your sales revenue, okay? This is very easy if you know this way to calculate, okay? Let's move on to next one, number 3. So here return on capital employed. ROCE, okay? Return on capital employed. So what is the formula for that? So you need to write here profit for the year or net profit, whatever you call, profit for the year divided by capital employed. Capital employed, okay, times 100, okay? For example, your profit for the year is $2,000, okay? Your capital employed is $20,000. multiply by 100. So what is your answer here? 10%. Okay. If you have this information available in the question, but how to calculate your capital employed? Already you know how to calculate your profit for the year if it is not given in the question. I showed you previous formula. Capital employed equal to capital employed equal to owner's equity. Okay, owner's equity. You know what is owner's equity? Equity. If you say it's capital, you're correct. Plus non-current liabilities. Okay. So owner's equity plus non-current liabilities. So already you know owner's equity means capital. The value of capital will be given in the question if you need to calculate ROCE. Okay. So what is non-current liability? You know, sometimes business takes some loan which stays for long time. For example, bank loan, debentures. Okay, these are taken in the business for long time, more than 1 year, 10, 5, 15 years. Okay, so these are basically your non-current liability. So if you have any non-current liability in the business, you take this non-current liability and you add with your capital, then you will get your capital employed. Okay, so this is how you need to find your capital employed to get the answer of this question. Okay, so there is another way you can calculate your capital employed. How? See here, capital employed equal to net current assets plus non-current assets. Okay, so this is another way to calculate your capital employed. Okay, so two ways to calculate capital employed. So here net current assets. So net current assets are also called working capital. Okay, so how to calculate net current asset? So you subtract your current liability from your current asset, you will get your net current asset. Okay, so what is your current liability? Like trade payables, other payables, bank overdraft, short-term loan. This will be your current liabilities. What about our current assets? Like bank balance, cash in hand, petty cash, then trade receivables, then other receivables. Okay, inventory. These are your current assets. Okay, so we subtract all of your current liabilities from your current assets, then you will get your non-current assets. Okay, so when you add your your current assets, so net current asset actually. So when you get your when you add your non-current assets with your net current assets, you will get the capital employed. Okay, by the way, what is your non-current assets in the business? Like assets those go for long time. Okay, in the business will be your non-current asset, like a motor vehicle, furniture, land and buildings, premises, and then machinery, equipments. These are basically non-current assets of the business. Okay, so you have to add those assets with your net current asset to get your capital employed. So it's very easy, yeah, if you know this process to calculate. Okay, so let us do next one, number 4. Okay, here we have current ratio, okay, RATIO ratio. Okay, so what is the formula here? You can say current assets divided by current liabilities, yeah. Okay, so current asset is also called what? It is working capital, yeah, working capital ratio. Okay, so here you have to divide your current assets by current liability. Okay, so already in the previous formula I discussed about your current assets and current liabilities. So here how to calculate the ratio. For example, your current assets are $10,000, okay. Your current liability is $8,000, okay. If you calculate, your answer will be 1:0.80, okay. This is the way you need to calculate your current ratio. Okay, number 5 is here, quick ratio, QUICK, quick ratio. So quick ratio is also called, if you say acid test ratio, then you are correct. Okay, so what is the formula here? Current assets minus closing inventory, yeah, closing inventory. Then what? You need to divide this by your current liability, yeah, your current liabilities. Okay, so first of all write your current asset, then subtract your closing inventory. First say your current asset is here $12,000, okay. Your closing inventory is $2,000, okay. Your current liability is $10,000. So if you calculate, what is the ratio? 1:1, okay. How? Here you have $10,000. If you subtract, here also $10,000, okay. If you calculate, it is 1:1. But point to be noted, if you already added your closing inventory here with this current assets, then you can subtract. If you do not include your closing inventory with current asset, then you do not subtract, okay. You don't have to subtract again, okay, because already you excluded, already you did not add it with this current assets. So this is all about our 5 formulas in this video, part 1. Another 5 formulas I'll show you in part 2, and then I hope you understood how to calculate this ratio. You please practice and learn these formulas properly, so that whatever question is given you can answer, okay, you can understand. Okay, that's all for today. Please subscribe my channel for more new videos and share this lesson if you think that this is helpful for you. So bye bye and take care. See you soon.